Welcome to session 3 of our unit 1 of the financial modeling course. In this session, we are only considering asset prices and returns. By the end of this session, we are expected to be able to explain the behavior of asset prices and returns. That's how asset prices behave compared to returns, and also we should be able to compete the different form of asset returns. Figure 1.2 depicts the price of the Ghana Stock Exchange All Share Index from 2011 to 2013. So you could clearly see that these prices moves from the 1,000 units that is in the earlier 2011 all the way to 2013. In this graph, you could clearly see that there were a series of up and down movements in this plot, where we started from the base, which is 1,000 units set. At this point, the prices were down, then it went up at this point. Then this picture or this graph depicted that at this point we had the least price, as this is the base, that this is the least price that the stocks were being traded on the Ghana Stock Exchange. Then all the way to this point, which stands the peak. So this is the peak. This is the highest price that a stock has been traded on the Ghana Stock Exchange. We should also understand that the price of the asset refers to simply the numerical value placed on assets in a market. So like the Ghana Stock Exchange, for instance, when you go to the Ghana Stock Exchange, there are a lot of firms on the Ghana Stock Exchange, and the index or the stock index is simply an aggregation or a weighted average of all the stocks that are being traded on the stock exchange on a particular day. So figure 1.2 depicts the movement, and the movements are simply the blue lines that we are seeing, and we see that they go up and down, up and down, up and down in that movement. They simply indicate that these price series are not stable. They move with time. They move over time, as at one point we were seeing them around the 1,000 units, that is the 1,000 currency units, and at some point in time they move all the way to this point where we could say it is around 600 units or even below, and all the way to this point where we had around over 2,000 currency units. So this is the average price that we are selling, or that the stocks are being traded on the Ghana Stock Exchange. Just like figure 1.2, figure 1.3 is also a depiction of the price series, but the difference is that the figure 1.2 was simply the raw price of the stocks on the Ghana Stock Exchange, but in figure 1.3 we are considering the Johannesburg Stock Exchange, which is the stock exchange in South Africa. And here we are collecting data from 2003 to 2015, which is a time series data. And then we could see that unlike the figure 1.2, which is the Ghana Stock Exchange price, which was in its raw state or raw form, here we could realize that there were a series of up and down movements, but these movements were not like the raw prices that were considered in the earlier example. Because in the first example, which is the figure 1.2, it was simply raw prices. Therefore, there were a series of up and down, and that the up and down trend or movement in the price series were mostly sharp, considered to here where we have already taken the log of this price. So for the Johannesburg Stock Exchange, the time series or the data on the JSE, which is the Johannesburg Stock Exchange, we could see that the prices are not in its raw state, they are log prices. We have found the natural logs of these prices, which is mostly suitable for financial time series analysis or for financial analysis or modeling. The data or price series or prices in their state are mostly not prudent, or they are not mostly advisable or they're not supposed to be used, or they are not helpful when we are using them for analysis. Therefore, we have to find, or we have to transform this data, and one way of transforming this data is to simply find the logs of this price series, as we have clearly shown in this graph. So you can see that here, instead of in the earlier submission, or in the earlier graph, or the earlier graph which we were considering the prices from 1,000 units all the way to 2,000 and above, here we are seeing 8 up to 9.4, which indicate that we have already found the log prices, or the logs of these prices, which makes the data set quite stationary or stable compared to the earlier graph. The price of assets or equity. We've already established that the price of assets are usually not stable. So we say they are non-stationary or unstable, and therefore, in order to be able to perform a proper analysis or quantitative analysis with some of these price series, there is a need for us to transform this data into a stationary set, or a stationary set, before we could conduct our analysis. And one way of transforming this data is to find the logs of this data. The logs of this data, that we found we difference the data using the logs. Here in our equation 1.4, we have the price series, which is PT, equal to PT minus 1 multiplied by the exponent of RT. PT is simply the current price of stock. So in the case of Ghana Stock Exchange, PT is simply the price of the stock, or the shares on the stock exchange, which we earlier saw moving from 1,000 all the way to 2,000 and even above. Then the PT minus 1 is simply the previous month's price. So we are saying that we can predict, or we can estimate our current price using the previous price multiplied by the rate of change in these prices. So the rate of change could either be on the decreasing end or on the increasing end, but the RT represents the rate of increase or rate of change actually between these price series. So this is one way of transforming the data set. It was earlier established that data set in its raw form is actually non-stationary or not stable, and it is not fit for financial analysis. Therefore, we have to convert this data, or transform this data into series of states, which will make them fit for analysis. Therefore, we prefer, or it is preferable to use returns. It is preferable to use returns for some of these analysis, because return series are mostly perfect for analysis compared to the price series, which are mostly non-stationary, or which have series of trend, or which are unpredictable. A return is a complete and scale-free summary of investment opportunity for average investors. What we are simply saying is that when we speak of return, it's like saying that we are only considering not the prices, but the differences, or the profit, or the benefit that one is likely to acquire or to obtain from investing their resources. So in simple terms, return simply has to do with difference in the prices. So let's say if we have, in simple returns, for instance, if we have, let's say, the price of our stock on, let's say, day 1 to be 20 cedis, and on the second day the price increased to maybe 25 cedis. In simple returns, in calculating our simple return, we simply subtract or deduct the 20, which is the previous day price, from the 25, which is the current day price, and the 5 will now become our return for the day. So the return simply has to do with difference, and find the differences between the price series. Also, we should be able to establish that returns are easier to handle than price, because they have mostly more attractive properties, which in this model it has been termed the stylized fact. So we are saying returns are easier to handle and they have attractive properties, and these attractive properties that the return series has over price has been termed stylized fact. So here we consider the stylized fact of asset returns. One, we are saying that time series data of returns are generally not identically or independent and identically distributed, which is IID. By saying the time series data of returns are not IID, we are simply saying that the returns, one, by saying they are not independent, indicate that the returns of today depends on the returns of the previous day, and the returns of tomorrow depends on the returns of today. So we are saying that you cannot differentiate between the returns of today from that of yesterday, or there are some interdependence between these return series. So the returns of today depends on the returns of yesterday, just as we said in our estimation. So we said in our simple consideration, which we said that in simple return calculation, we are considering the price, the previous day price, and the current day prices. So we cannot take away the previous day prices from the calculation of our returns. Therefore, they are not independent, so they are dependent on each other. So the returns are dependent. So the returns of yesterday will definitely have influence or impact on the returns of today, yes, in that manner. And they are also not identically, or they are not identically distributed. By saying that the returns are not identically distributed simply indicate that they are not normal. The data sets are not normal, or returns are not normal. When we say they are not normal, we are saying that a data that is normal indicates that a half of the data set represent the other half, or it's a mirror or a direct mirror of the other part. So if we are to depict this data in a table, or let's say graphically, then we should see that the average of this data should be found right at the center, or at point 0, to indicate that the data set is identically distributed. But mostly returns are not identically distributed, and we should keep note, or we should consider it. The next factor, or the next point to consider, is that the volatility of returns generally is mostly not constant. By volatility, we are looking at the fluctuations, the consistent fluctuations in the price series, which also have impact in the return series. So we are seeing that the fluctuations are not constant. There are changes in the fluctuations, where we could have negative or positive changes or news in the market. Therefore, the news impact are not equal. So the volatilities or the changes in the fluctuations will not be equal. And also, the other stylized fact to consider is that the absolute or the squared returns are highly autocorrelated. But autocorrelations, like the issue of not independent or not dependent. Here, by autocorrelation, we are simply saying that the returns are interdependent, or they are correlated, or they are dependent. So meaning the previous day returns has some impact, or has impact on the current, or the current is dependent on the previous day, and they are in a way interlinked. They are not independent. And also we are saying that the returns have fat tails, or the return series generally, or financial data sets of financial returns are mostly exhibiting fat tails. By fat tails, we are saying the fat tails of the data set also comes from the identical distribution. We said that they are not identically distributed. Therefore, the data sets are not equally distributed, and therefore they have fat tails. But the fat tails, we are saying that there are mostly extremes, or data sets that are found on the extreme end of the data, which we depict them graphically. Therefore, they are not normally distributed. So as we said, the next point that return series are generally not normally distributed. So they are not normally distributed, and that we should also consider this fact. We are also saying that the log returns, as a stylized fact, the log returns are not Gaussian. They are not Gaussian. What we mean by the log returns not being Gaussian is that the data sets are leptoketic. That is, they have unequal peak, or the tailness or the heaviness of the tails of the data set are not the same. So they have different, as we said, they have fat tails, but the data set, or the heaviness of the tails, or the extremes, both the negative and the positive extreme of the data set are not equal, indicating that they are not Gaussian. Another stylized fact of return series is that they are serially correlated. But mostly, we are saying that the returns in their absolute form are serially correlated, but the log returns are not. Just as we earlier said, the absolute are autocorrelated. The serial correlation and autocorrelation are simply the same thing. So we are saying that they are the absolute returns, which is the returns that from the actual price without the log, or without first finding the logs of those prices before the differences, finding the differences, are mostly termed as absolute returns. And these returns, we are saying they are not independent, or they are serially correlated, indicating that they are interdependent. And also, we consider the issue of volatility clustering. We are saying that the return series tend to cluster. By volatility clustering, we are simply saying that we are looking at how high volatility events are followed by a high or even higher volatility events. So fluctuations, both higher and lower, or up and down fluctuations. The return series, or mostly the returns of financial data, are mostly clustered. They are mostly, we are saying that there is a chance that if there was a higher, or let's say a bad news in the market which had impact on the trade or the market today, or a negative impact, we are saying that on the next day there will still be the same trend. So until the market is able to digest this information, it will not come back to its normal, or back to normal. There will still be these consistent fluctuations, whether negative or positive. Therefore, we are saying that they are volatility clustering. So we are saying that a volatile period tends to be followed by another volatile period, and intuitively the market becomes volatile where there are news, or a bad news, where the market participant will have to take time to digest this news. And also, there is gain or loss asymmetry. Asymmetry simply has to do with unequal nature of, or unequal nature of something. So we are saying that the impact of a gain and a loss in a market are not the same. So assuming you are an investor, if you invest in a market, the way you would treat a loss will not be the same as the way you would treat a gain. So we are saying that mostly in financial markets or financial data, it is always shown that it has always been established that the loss always have a higher impact compared to the gain. How people will consider a good news will not be the same as how they will consider a bad news. Mostly people will tend to weight the bad news compared to the good news. So the reason why we are saying that the gain or loss in the market are unequal, so there are asymmetry in the gain or loss. So time series or return series data mostly exhibit these properties. And also there is what we call the leverage effect. We are saying that with the leverage effect, we are saying that large negative returns tend to increase volatility than do positive returns of the same magnitude. So as we said in the gain or loss asymmetry, negative returns, which is losses, tend to have higher impact, or tend to have a higher, or tend to have an extended impact on the market compared to a positive or a gain of the same magnitude. Transformation of financial asset prices to returns. We have already discussed, we have already highlighted on the transformation, as we said that price series in their raw state are not perfect for modeling or financial analysis. Therefore, there's a need for us to transform these prices into returns. And we said there are a series of ways that we could transform this data, and one of these ways is simple returns. In simple returns, we can simply transform price to returns by calculating the simple differences in the price series. So it's like we having the example I started earlier, that let's say the price of stocks is, let's say, 20 cedis today, and tomorrow it increases to, let's say, 25 cedis. In calculating our returns, we are simply subtracting the old price, which is 20 cedis of previous day, from the new price, which is 25 cedis, to get our returns as it has been depicted in our equation, where RT represents the return series and PT is the price of the current asset of, let's say, in this case, let's say stock, so the current stock, and PT minus 1 is the price of the asset in the previous period, and price of the previous period could be the previous month or the previous day. In calculating or estimating the simple returns, there are a series of statistical tools that will help us in doing this transformation. Mostly we are not going to do this manually. There are a lot of ways that there are tools that will help us. And in this model, for instance, we are using the eViews. The eViews will help us in all our estimations. So similar to the simple returns we considered earlier is also the log returns. So the simple returns and the log returns are mostly the same, with the only difference being that with log returns we first find the logs of this price series, as we saw earlier with the Johannesburg Stock Exchange. Here we find the logs, the natural logs of the prices of these stocks or assets before we do the simple difference. So the log returns has in addition the log difference before we engage in the simple difference by subtracting the previous from the current over the series or the price or the return series. The log returns of an asset is defined as we can clearly see in equation 1.7, where RT represents the log returns, ln PT is the logs of the current price of the asset, and ln PT minus 1 is also the logs of the price of the previous period. Log returns are also known as log price relative and continuously compounded returns. Here, the frequency of compounding does not matter. So we are saying that the log returns have the nice property of being time additivity. For example, if you want to estimate the log returns of an asset over a period of, let's say, 1 week, which in this case we have only 5 days, the equation 1.8 or the equation, we could clearly see that it is possible, as R1 is the log return for period 1, R2 is for the period 2, R3 for period 3, in that manner. So the ln P1 over P0, so P1 is the current and the P0 is the previous. So we can find the log returns using the ln P1 minus ln P0, and also we can even estimate the log returns of an asset over a period of time, as we've seen in the final equation, which is ln P5 minus ln P0, which is the returns of the entire period from period 1 to period 5. So in this session we have considered asset prices and asset returns, and also we have dealt with, or we have considered, transformation of prices to returns using simple and log returns. Now next session we are going to continue with the asset prices and the return estimation using the eViews. Thank you.